one, retail banking, and two, the changing banking scenario with technology advancement. So the key issues facing the Indian banking industry today are for asset quality, capital adequacy, financial inclusion, and talent management. Despite being the second largest populated country in the world, and with 87 banks, 81 rather, plus 6 financial institutions, we are able to reach out to only 50% of the country's household. And why is that? In 1929, in The Economist, an article said that a small man living in the provinces is neglected. And how true is that? The banking industry sector has woken up to the fact that there is potential in the unbanked areas to enter uncharted territories and capture unsaturated segments. The banking sector will have to come up with innovative operating models which will be different from conventional ones. Technology will be the essential to access this market, as extensive branch networks in remote regions may not be economically viable, as explained by Mr. Sanjay Thomas. Break-even period for a rural branch could take upwards of 3 years. Hence, technology-driven models such as mobile banking will inevitably change banks' operating model and help banks in lowering the cost-income ratio. Technology is not only making banking convenient for customers, it has also allowed banks to expand their business faster and bring down the costs. Typically, when a customer walks into a branch to withdraw cash, it will cost probably 200 rupees for that particular transaction. But if he's transacting at an ATM, it will be 20 rupees for the transaction. So the cost benefit really works in favor of both the bank and the customer, and it's a win-win situation. So technology here plays a very important role. Technology-based banking has also reduced the space requirement for branch banking. Earlier, if you had seen, the branches used to be 5,000, 4,000 square feet areas. Nowadays, if you see a bank, it can work within 1,000 to 1,500 square feet of an area. But modern electronic system of transactions is still concentrated in metros and large towns. But usage trends clearly show a significant year-on-year increase in the usage of alternate channels for transactions like ATMs, internet banking, and mobile banking. Just to share some data with you, the number of mobile banking transactions has doubled to 5.6 million in Jan 13 from 2.8 million in Jan 12. The volume of transactions, the value of these transactions has also increased threefold to 625 crore in Jan 13 from 191 crore in Jan 12. The ATMs have also increased number of ATMs from, say, probably 74,000 in FY11 to 1,22,000 in FY13. The internet banking usage channel has evolved over the years. Internet banking usage in India has increased by a whopping 77% from when it started in 2006. So there is a huge scope for increasing this usage by popularizing the technology, internet banking, ATM, mobile banking to reduce the cost, and there is definitely a drop in branch channel usage by 15%. So I will say that technology has become a key to success. I would also like to share that ATM, when we say ATM, probably you all will say that rural population may not be benefiting from it, or semi-urban may not be benefiting from it, but the statistics say that at least 7% of rural population does use ATMs, 22% of semi-urban, and the rest of it is urban and metropolitan. I will move on to how banking has changed and how it has changed. Gone are the days when bankers used to be very happy to service a walk-in customer and were happy doing this and nothing else. Banks have revisited their strategies for attracting CASA accounts, term deposits, by aggressively pursuing customers, by having focused approach and innovative bundling, promise of better returns, and higher level of customer service. Saving habits of customers have also improved, or changed rather, and middle class has evolved as a strong customer. When we say middle class, earlier we used to only do saving accounts or term deposits. Now, investment in banking products may not be the default choice for middle class. The customers are more interested in different options of investments like mutual funds, bonds, gold, commodities, and some even paintings. Some of the foreign banks that I know of are also offering these services where painting is considered as an investment option. So customers are becoming more and more aware of the investments, and if you want, as a banker, to increase the wallet of share from the customer. Typically, a customer has nowadays 3 to 4 banks, and it is very difficult to read a customer. They have very different needs. There exists a set of customers who access to a variety of financial products across institutions. These customers have transient relationships with multiple banks, a current account with one bank which will offer no charges, a saving account with bank that offers higher rate of interest, a mortgage with offering best rate, or a brokerage account with discount brokerages. This is where increasing the wallet share comes into picture, understanding the need of the customer, gaining his or her trust, and get the customer to open maximum number of accounts with your bank. For this, the officer dealing with customer needs to gain the trust of the customer. I'll move on. This was the liability part of the business and understanding the customer, and the technology part which helps the banking industry. Retail credit is another part of the banking, where retail credit will bloom, but not all banks will be able to manage the challenges. Due to increase in the purchasing power of middle class, with evolving appetite to take a debt for acquisition of asset and supporting their aspiring lifestyle, significant growth is witnessed in the financing of automobiles, mortgages, white goods, consumer durables, etc. India has massive room for this high growth in these areas, as the level of retail credit penetration is extremely low as compared to the developed or the developing countries. From the demand side perspective, rising incomes, asset ownership aspirations, and low perception of risk in funding is fueling the rapid growth of retail growth. On the supply side, banks and NBFCs are stepping up their strategies to garner this business by leveraging the credit data, speedy assessment of risk, and rapid processing of credit. According to CRISIL, aggregate car and utility vehicle loan disbursements will grow at a CAGR of 18 to 20% till 2016 and 17. A steady growth of underlying vehicle demand, increase in finance penetration, and higher loan-to-value ratios will drive disbursements over the next 5 years. Same is the case with housing finance. Few leading banks have gained dominant market share through a focused approach that identifies need of the customer, especially middle class, aligns its products and operating models to meet these needs. The new middle class, however, segment is likely to be fickle in its banking relationship, given the very low costs of and multiple available options for switching. Hence, the key to building a strong relationship and a profiting relationship will be the ability to build trust over a series of transactions. So, according to a study which says that 69% of customers in the high and upper middle class group will tend to remain with the same bank when choosing to buy a financial product, even if the bank did not quote the best price. A key aspect to this challenge will be the bank's ability to build and retain a team that is trained not only in the nuances of the products and services they sell, but also in the development of soft skills and trust building skills. The emerging middle class is likely to value the relationship higher if their point of contact is something they trust. I'll move on to the MSME sector, which Sir had contribution of this segment to India's gross domestic product has been holding steady at 11.5%. Yet, MSMEs faces a chronic shortage of bank financing to aid its growth and improvement. And why is that? That is particularly because of the ownership structure of the enterprises in MSME. That is dominated by the proprietorship concerns to the extent of 95%. And that is the unorganized sector, wherein less financial transparency is there, there is no collateral for offering, and only 1/3 of MSMEs have access to organized financing channels in India. The slow growth of MSME is broadly attributable to the lack of financing or lack of facilities. Only 33% of balance prefer of the 33% of MSMEs prefer to do institutional financing, and balance prefer to raise financing through personal sources like family and friends and informal financiers. There is a huge potential to meet this unmet demand and give a significant opportunity for flow of credit to the banking credit. To encourage greater bank-led financing, RBI has increased its focus on this sector through directed lending policies such as PSL norms. As I said earlier, most of the credit flows to registered enterprises, and the MSME sector, 95% is proprietorship concern. The risk associated or perception that is attached to unregistered enterprises is due to the lack of transparent financial data, limited immovable collateral, preference of less hassled informal financing, reduces addressable demand considerably. I have been handling MSME for last 2 years in IDBI Bank, and when I actually go to source business or actually go to sanction a particular loan, we come across levels of difficulties right from getting financial papers from the customer. Basically, they do not understand what the banking needs, and the bankers always work on the papers. So all the transactions don't get captured in their banking system. They mostly work on the cash, and they are completely unorganized, basically. So to make them financially literate, as has been said by Sir earlier, is a challenge, but which needs to be met by the banking professionals like us. Generally, working capital finance is what they look for, and it's very less degree. Debt for capital expenditure is looked for by the MSMEs. There are a lot of initiatives which have been taken. IDBI happens to be one who finances all the small-scale industries or MSME priority sector lending. Here also, again, public sector banks account for over 70% of debt financing to this sector, and private sector and foreign banks would be to a lesser extent. So the challenges which we face as a banker and the challenges the MSMEs face as customer are there and will continue to be there unless we tell them financially how to come to us with papers, and we are able to help them. There are a lot of facilities which even government, not government exactly, it's the MSME ministry which has come up with CG